Welcome to The Explainer. Today, we are tearing into the financials of Johnson Controls International. We're going to look at all the key numbers to build a full picture of the company's health and its valuation, giving you the stuff you really need to know from an investor's perspective.
Okay, so let's just get right to it, right? The big question on everyone's mind, is this stock a smart buy right now? We're not here to give you advice, but we are here to give you the tools and the data so you can make your own call. So let's start digging.
Okay, first things first, let's just get a feel for the sheer scale we're talking about here. The market values Johnson Controls at over $87 billion. That's its market cap, and it tells you right away, we are dealing with a massive global company. So yeah, it's a giant. No question about it. But that $87 billion figure, it's more than just a big number. It's what the entire market thinks the company is worth. Let's quickly unpack what that actually means. For anyone who's kind of new to this, market cap is actually a super simple but really powerful idea. All you do is take the current stock price and multiply it by all the shares that exist. Boom. That's the price tag the stock market is putting on the entire company.
All right, so we know they're huge, but how has the stock actually been doing for the people who own it? Well, if you look at just the last year, it has been quite a ride.
And man, these numbers show you it has been one heck of a roller coaster. The stock basically went from a low of about $80 all the way up to almost $147, all inside of 1 year. That is a massive swing and a really clear sign of some serious volatility.
And this number right here, this just nails it. From its lowest point in the last year, the price shot up more than 77%. I mean, that's an incredible gain in a pretty short amount of time.
But if we kind of zoom out a bit, we see this isn't just a straight line going up. Looking at the year-by-year returns here, you see a huge 77% gain in 2021, but that was followed by an almost 20% drop in 2022. And then, bam, it roared back with a 54% gain. So you see the pattern, right? Big swings. So you'd think, with a stock performance like that, the company itself must be absolutely crushing it, right? Well, this is where the story gets really interesting, and honestly, a little weird. Okay, this slide right here, this shows a huge disconnect. I mean, a massive contradiction right at the heart of their financials. On one hand, you have net income. That's the official profit on paper, and it's skyrocketed by an amazing 94%. But on the other hand, you have free cash flow, the actual cash the business is bringing in, and that has fallen off a cliff, down almost 50%.
Yeah, this is a big flag for any investor. Look, profit is one thing. It's an accounting number. But cash is king. Cash is real. It's what pays the bills and what gets returned to shareholders. So how on earth is one soaring while the other is just tanking? It's a critical question we got to keep in mind.
All right, so this brings us right to the core of it all. We've seen the stock's been on a tear, and we've seen these really conflicting signals on growth. So now we have to ask the big one. What is this company actually worth, and does that price tag make any sense? So one of the classic ways to figure out what a company's really worth is to look at the cash it can make. There's this model that basically tries to predict future cash and figure out a fair value price for the stock today. And remember, it's all based on that free cash flow number, the one that's been dropping.
And here it is, the number that model spits out. Based on its recent cash generation, the fair value for a single share of Johnson Controls is estimated to be just $50.56.
Okay, now let's put that into perspective. The model says about $50, but the stock was last trading at nearly $142. That is not a small difference. That is a massive gap between what the model says it's worth and what people are actually paying. So investors have this thing called the margin of safety. Think of it like a buffer, a cushion against being wrong. You want a big positive buffer, right? Well, look at this. A negative margin of safety of 180%? Whoa. That is a huge warning sign from this model, screaming that the stock could be way overpriced based on its cash flow. Okay, let's look at this from another angle. There's something called the price-to-book ratio. It's pretty simple. It just compares the stock price to the company's net worth on paper. It tells us how much of a premium the market is willing to pay. So Johnson Controls' PB ratio is almost 6.6. That means investors are paying over 6.5 times what the company's assets are worth on paper. But here's the kicker. That's 58% higher than its own average for the last 5 years. People are paying way more of a premium for this stock today than they have in the recent past. Okay, so the valuation looks pricey, to say the least, But hey, maybe the company's financials are so rock solid it doesn't matter, right? Let's do a quick health check. All right, this table gives us a quick look under the hood. The debt looks pretty manageable, nothing too scary there. But look at the current and quick ratios. Both are under 1. Now, those numbers tell you if a company can pay its bills right now, and being under 1, well, it can signal that things are a little tight.
All right, we have covered a lot of ground here: performance, growth, what it might be worth, and its overall financial health. Let's pull it all together now and see the two completely different stories the numbers are telling.
And this is really the whole story right here, a tale of two very different companies. You've got the bull case, the argument for the stock, which is all about incredible performance, right? Amazing profit growth, great return on equity, and that powerful stock momentum. But then you have the bear case, the argument against it, and that's all about the fundamentals. That shocking drop in cash, a valuation that seems totally detached from that cash, and a balance sheet that's just a little stretched.
And that's really what it all boils down to, isn't it? You've got this classic fight: incredible momentum versus some really worrying valuation numbers. A story of fantastic performance clashing with a story of shaky fundamentals. So for you, as an investor, which story shouts louder?